After quite a November run-up, dozens upon dozens of stocks hit their peaks and now remain overvalued. So much so that insiders from a lot of these dominant companies out there are just offloading shares. Now, if you have the money to invest, say an extra grand laying around, let me tell you, it's better to have time in the market than trying to time the market itself. And despite popular belief, there are plenty of opportunities out there for long-term investors, 7 of which I'm covering today just after we cover some macros. With that, let's go ahead and dive right in. So the first question that we as investors ought to be asking ourselves is, what in the world happened? I mean, how in the heck did we just go from soaring to new heights to losing our footing on our ascent to achieving higher highs? And the answer? Well, it all comes down to our macros, which is exactly why I always, at least for a brief couple of minutes, like to cover what I feel you, me, and any self-proclaimed investor out there really needs to come to understand or even worry about to make wiser investment decisions. And right now, the trouble all lies within the uncertainty factor amongst us investors, all revolving around, of course, the Federal Reserve. You see, as we speak, the Federal Reserve is actually off the grid, and what this period is known as their blackout period, which occurs just about a week or so before their FOMC meetings. Now, from what I've really come to understand, solely by studying the market reactions during these periods of time, is that there tends to be more emotional investing that takes place, because there's an absence of negative news, or rather speak of interest rate hikes. But then something pretty interesting happens as soon as we get closer to the interest rate hike announcement date. The market goes a little haywire from all the angst and uncertainty that continues to brew in this time. Now the big question becomes, will the Federal Reserve jack up interest rates by another quarter basis point or so? And to be honest with you, I don't really think the Federal Reserve is going to head in that direction this go round. Even Federal Reserve officials hinted that interest rates might be sufficient right now, even though that there's stubborn inflation coupled with an overall strength in the labor market. However, the bottom line is this: we can't rule out what Powell's going to do because it's all contingent upon the data. But this FOMC meeting, there's actually a dueling question that the Federal Reserve must provide answers to, which is, when exactly will the Federal Reserve pivot to ultimately trim interest rates back down? And could it be sooner rather than later, like before the elections? Would it be after the elections? And that then all leads us to question how businesses are ultimately going to fare in such an environment. Now, as we saw, tech insiders, primarily from the Magnificent Seven, have been trimming their positions and taking profits, while their stocks are of course overvalued. But what about us longer-term investors? Well, I say don't panic. A matter of fact, double down on some of those dividend stocks that have actually come down as a result of the tech craze and the anticipation for an entry into a bull run, which leads me to the 7 dividend stocks that we're going to be taking a look at right now that are looking better and better as we speak. Now, as for the first dividend stock on our list, it's ExxonMobil, ticker symbol XOM, which is one of the largest gas and energy corporations in the world. Whether it's exploration, development, refinement, distribution, ExxonMobil leads the charge regarding petroleum products. And as we head into hopefully what is a greener future, Exxon is actually there pioneering energy alternatives as well. But Exxon is on today's list because the stock is actually back down from just a couple of months ago when it was trading for $120 per share, now trading for just $100 per share at a P/E ratio of 10.2. And actually, what we're typically looking at here is the fluctuations in these ranges as seen throughout the year. But what's now very notable is the growth over the last decade, as it's appreciated over 60%. Moreover, I'm excited because when it comes to ExxonMobil, given their most recent announcement to buy shares back, lower emissions, and attempt a merger, we are taking a look now deeper into this article to discover $20 billion worth of shares are going to be bought back, of course propping up some value in the stock. But now, that planning aside, analysts also remain optimistic here with over 31% worth of upside predicted, coming up to $132 per share. And until then, dividend investors, we're going to enjoy their dividend because it's got 25 years worth of dividend history with a growing dividend year over year by 2.6% over the last 5 years and a current dividend yield coming in at 3.78%. Next up, let's go ahead and talk about the industry-leading dividend powerhouse Kimberly-Clark, ticker symbol KMB, which is not exactly or in the slightest exciting, sexy or anything in between to invest into, as it manufactures personal care products like toilet papers, Kleenex, and diapers. So perhaps again, not the most exciting opportunity, but a lucrative one to simply hold for the longer term, as it's seen over 64% worth of appreciation over the last 10 years. But as of right now, as we're speaking, it's down nearly 9%, trading for $121 per share with a PE ratio at 23.3. That's low for Kimberly-Clark given the safety that it actually provides to shareholders. The times more recently have given way to actually growth stocks picking up a lot of momentum, but the interesting fact here is that we see hedge funds pouring money into Kimberly-Clark, over 33,000 shares purchased by hedge funds last quarter. And simply holding on to Kimberly-Clark, you're going to go ahead and take advantage of the dividend, with quite a track record coming in at 50 years worth of a dividend growth at 3.43% worth of a growth rate, and a reliable dividend yield coming in at 3.89%. Now, investors, before I move on to cover the next 5 dividend stocks, I'm coming in with 2 requests for you, both of which I think are a win-win for all of us. So request number 1, if you've already taken value away from this video, I want you to go ahead and tap on that thumbs up button for me, so at least I know that this is the content that you're looking for. Therefore, I'm going to keep producing more content just like this. Now, request number 2, as we speak, we're just about at 10,000 subscribers, and sadly 72.2% of you aren't subscribed. So I want you to help me, or I help you, whatever the whole thing is, and we can go ahead and reach financial freedom together. Join me here by subscribing. With all of that out of the way, dividend stock number 3, we're going to go ahead and dive right into one of my favorite stocks. It's one poised for what I think is going to be very strong growth come the future, Stanley Black & Decker, ticker symbol SWK, aka the largest tool manufacturer in the entire world. And while I feel many of us are so busy pouring money into Lowe's and Home Depot, which all makes sense given their outstanding companies, the real question is, who do you think their supplier is? And moreover, once construction actually picks back up and we get a reversal in the housing market, think about the Stanley Black & Decker comeback, which is why I always say Stanley Black will be back. But as for now, we can see that over the last 3 years worth of mayhem, after everyone put their shovels and paintbrushes away from their DIY COVID projects, well, the stock plummeted. Once trading for over $200 per share, now just at $91 per share. That's a 44% drop. Now, it has been on the come up this year, rising by over 24% already. And of course, my take is now remaining long on this type of investment, as we see over 40% worth of appreciation, even incorporating that major drop over the last 3 years. Most importantly is to understand that this is not going to be an overnight rebound. It's going to be a rebound nonetheless over the span of time. So enjoy the dividends in the meantime, as we have a dividend history with Stanley Black & Decker of over 55 years at a 4.53% growth rate over the last 5 years and a current yield at 3.55%. Now, if Stanley Black & Decker is a little too troublesome for you, I totally get it, but we can go with another great ultra-safe long-term investment, Procter & Gamble, ticker symbol PG, which is of course the consumer staples kingpin, as they manufacture and market anything from baby diapers to fabric detergents and softeners, as well as grooming and hygienic care products. Now, they've been in business since 1837. Investors, Procter & Gamble is likely not going anywhere, at least anytime soon. And I'd really like to say here that it's never going to be insanely undervalued, but when it slides to $146 per share on a minimum, it should make it onto your watch list, especially as it's appreciated by over 130% over the last decade, while analysts just continue to predict upside, coming up to $163 per share. It's over 11.5% worth of growth. In addition, here we have hedge funds who have been buying hand over fist over 4.8 million shares last quarter. But now here's where Procter & Gamble really comes in strong for a buy and hold forever type of investment. We have over 67 years worth of growth at a 5.63% growth rate and a solid, reliable dividend yield coming in at 2.56%. Now, very similarly to Procter & Gamble, at least in the aspect of safety, let's talk about Hormel Foods, ticker symbol HRL, which is solely in the business of food processing with plenty of brands that I am certain are littered all over your pantry, at least for me, enjoying a lot of Skippy peanut butter. However, we're here for the depressed stock price to score a real discount, and we may just get that holiday score, as Hormel is actually down by nearly 30% on the year, trading for just $31 per share. Now, given the nature of the company in food processing, it will ebb and flow, but ultimately grows year over year, and we can see here over 66% worth of growth over the last decade. And while we haven't seen a lot of hedge funds pouring money into the stock just yet, we are seeing some hedge fund activity begin here, from Maverick Capital pouring money in, Fisher Asset Management, as well as Gotham, likely for the reliability factor with Hormel, as it's dished out over $50 57 years worth of dividend growth at a 7.96% growth rate while maintaining that 3.61% dividend yield. Next up, the one company that for whatever reason drives customers crazy and distraught when it comes to their holiday cup designs. We're talking about Starbucks, ticker symbol SBUX, which has been pitter-pattering rather recently regarding its share price, but ultimately trading, at least as of this video, for $95 per share, which is down by 3.26% year to date. However, I want you to notice all the peaks over the year with Starbucks, as it's completely dependent on consumer sentiment. But what's really important to note about Starbucks is the actual health of the company, not the patterns of the share price, because Starbucks just continues to grow and amass a larger and larger portfolio worth of storefronts. And because of that health, we do have Starbucks that has grown by over 187% over the last decade. And now based on that, well, right now we're seeing analysts who are forecasting 17% worth of growth, coming up to a share price of $112.40 per share, while 285,000 shares were purchased by hedge funds last quarter. And as we enjoy those mocha choca sugar lattes from Starbucks, we can also enjoy their dividend growth with 13 years worth of a track record at a 10.35% growth rate over the last 5 years and a solid yield coming in at 2.39%. But now, if there is one dividend stock that I think we could all bank on for a major comeback that really relies on the rallying of the NASDAQ, it's T. Rowe Price, ticker symbol TROW, which is a global investment management firm with their assets planted, as mentioned, in the tech-heavy NASDAQ, which means that T. Rowe Price actually feels all the quakes and shakes of the market and has been experiencing plenty of volatility. And right now, we can see that just based off the Federal Reserve moves and remarks, their stock is ebbing and flowing exactly as it should. It's almost down by 5% here, trading for $100 per share on the year. Now their PE ratio is coming in at 14.5, but go ahead and take a look at this long-term track record here. We get over 75% worth of appreciation, which is what I think smart money is now all over, pulling that trigger on 648,000 shares bought up by those hedge funds last quarter. Now, as for us dividend investors, when it comes to T. Rowe Price, the appreciation is great, but these dividends are even better. Over 36 years worth of a history at a whopping 12.73% growth rate, coming in strong with a dividend yield at 4.85%. Investors, there you have it. 7 dividend stocks worth your attention right now. Let me know your thoughts on each of them down in the comment below. Find more dividend insights right here, but before you click away, make sure you're subscribed so you never miss a single dividend stock idea.